Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 20 minutes here on Options Guide TV. I decided on a travel day for me, Monday, October 20th, that I would put together a little presentation on how to calculate the VIX futures contracts for a specific expiration. And now this has happened because recently on Options Guide TV, we put together about 3 or 4 trades on the VIX, mainly because of the general volatility of the marketplace. So during those presentations, you always have a little bit of trouble trying to explain them because the options that trade in the VIX index usually don't trade off the value of the actual VIX index. They trade off the futures contracts. And the way that I've always explained this as far as the VIX is concerned is, trading options on the VIX is like trading options on the weather, in that you have no idea where the weather's going to be next week. Just because it's extremely hot today doesn't mean next week it's going to be extremely hot all week long, right? Trying to guess where the weather is going to be is a real complex situation. And that's the same way with volatility in the marketplace. If I'm thinking about trading the volatility of the marketplace next week, it doesn't have a lot to do with where the VIX is at this point in time. The thing about it is it gives you a little bit of an indication. There's a higher probability of something repeating itself. So if the VIX is at 24 today, your best guess would be that it would be at 24 next week on Friday. But with that said, you still have a lot of different variables in the VIX. And one of the biggest things that makes it tough to trade is if you're thinking of futures and you're doing futures on corn, the future can be figured out by just taking, what's the cost of a bushel of corn at this point in time, and you add in the carry cost, and you can have a reasonable valuation what that future should trade for. Well, you can't buy volatility, right? You can't do that. So the futures, you could have the futures in November trading way higher than the futures in January. And why are they trading higher? There's no really rational reason. It just is what it is. And so the VIX is a interesting and fun underlying to trade, but you do need to know this information that I'm going to share with you today. All right. So I went into the Tradier Pro software and I grabbed a screenshot of the VIX. Now, last Friday, we did a bear put spread in the VIX index, and that was Friday, October 17th. So I'm going to try to feed off of that trade that we put together on that show. And so here's a screen grab of that show on that day. And the VIX was trading around 24.84. Now the markets were moving, so these things aren't going to be accurate. But market had a big move up. The VIX was trading right around this level. I grabbed the November expiration that the month that we're going to trade those options. It goes out 33 days. And I'm going to get bearish because I'm thinking as we go into November, we'd see volatility come off. Maybe the government shutdown might be taken care of, hopefully by then. And then we see a drop off in the actual volatility of the marketplace, and hence the trade would be profitable. So we need to know what the VIX futures contracts are at. And the VIX futures are going to be trading lower than where the market is at because we just had a big spike up in the VIX. So looking at the strikes, the first thing that I do when I'm just trying to figure out the futures, and if you don't want to do the calculation, a simple thing to do is just look at, this is the call side of the trade. This is the put side of, well, I should say, of the chains. And you just try to see where they match up, right? So the call here is trading for $3.10 on the ask, and the put is trading for $3.20 on the ask. So they're almost the same prices, which means that the VIX future for the November 19th expiration is going to be very close to 22. Well, if we then click buy on the call and we click sell on the put, that is called a synthetic long stock. The call option means you have the right to exercise and buy the stock at 22. The put option would mean that you have the obligation to buy the stock at 22. So if you do the math there, no matter if the market goes up or goes down, you would either be buying via the call, via exercise, or you would be buying via the put versus being assigned. So that's synthetic long stock, and that's where that comes from. And we see that from the Tradier Hub. I grabbed a screenshot, and at that moment, the midpoint for this combination was 10 cents. And so that would imply that the market, if it's 22, and we're looking at the call side of things, and you're getting a credit, that means that you're going to subtract that from the strike price. At this moment in time, when this trade was put together, the futures contract was trading at 21.90 with the actual VIX index at 24. So what does that mean? Well, that means that this is the at-the-money option contract, right? So if you go up to the 24 strike, you see that that is trading for a lot less than the 22 strike, and vice versa on the put side. This is a deep in the money put as opposed to an at-the-money put on the 24 strike. So this is what we need to know if we want to trade VIX options on the actual VIX index that you put into your option chain. All right, so now I did the math, and the math will turn out to be a little bit different in that I actually, when I looked at the futures on this second, we could get this trade done, and I just kind of wrote it out so it's a little easier to see, a little bit easier to understand. The no future at that moment in time was 21.80. It means it went down a dime. We bought, if you did the combo, and this is the math for the combo, you bought the November 19th 22 strike calls and at the same time sold the November 19th 22 strike put, you could have got that done for a net credit of 20 cents. If it was a net debit of 20 cents, you would add it to the strike. Now that it's a net credit, we're going to subtract it from the strike. So in this instance, so this is synthetically long stock. That's another way to say this, synthetically long the VIX, if you will. And the VIX future is 22 minus 0.20 or 21.80 in this instance. So we put a trade together. Like I said, on Friday, October 17th on the Options Guy TV inside the Tradier Hub, I actually proposed a paper trade in the VIX where we got short the VIX index. Now, when I did this trade, the November future was at 21.54, and if we looked at buying a put vertical spread, otherwise known as a put debit spread or a bear put spread, there's many different ways to say it, but the risk is going to be the net debit that you paid for it. So we bought the VIX November 19th 22 strike put, and then we sold the 19 strike put, brought in a net debit of 180 or 180 per 1x1 bear put vertical spread. And don't forget, you got to add commissions on or any fees, because that's going to be your max risk, and those are important. But at expiration, if the VIX is below 19, which it was below 19 not that long ago, your max upside would be the difference between the strikes, which is $3, minus the net debit paid of 180 or $1.20. And the max loss would be that net debit of $1.80, or if you want to put it in a dollar amount, $180 per 1x1 bear put vertical spread that was put on. Now, I wanted to share with you, so that was the paper trade that we put together with the VIX at that price. Now, I wanted to share with you something that is on the Chicago Board Option Exchange. It's not the ideal situation in that they're delayed futures quotes, but if you go to this URL down here, or you just do a search for delayed VIX futures CBOE, you can find it pretty easy by doing that. But this is what comes up. You'll see these different expirations. Now, these are weeklies. And first of all, I always say if I'm trading the VIX, I don't like to trade the weeklies. Weeklies, dailies, anything that's in the VIX index, those are very illiquid options. Now, the actual monthly expirations, you actually see the quote on here. And you notice they don't have the delayed futures on these weeklies. They only have them on the monthlies. But you see the plethora of difference as far as volatility is concerned. When this screenshot was captured, the actual VIX, the expiration that the nearest term expiration was at 23. The expiration that we're trading was at 21.54. And then if you go out to the November monthly expiration, we're down to 21.40. And then, what the heck, February's at 22. Why? Who knows? Nobody knows where volatility, what's going to be the weather on February 18th at your house. What do you think the temperature is? Well, you'd look at where the temperature is today, and you'd make an educated guess, and that would be your best bet. There's no fundamentals that you can do. You can't analyze the earnings of the VIX, I say jokingly. But with all that trade, this is the concept. So there's a place that you can find it, or you can just do the math, or you just literally look and see where does the call and the put basically line up and trade for very close to the same value. And then wherever that strike is, that's a good chance that's where the VIX futures contract is traded. So with that said, my name is Brian Overby, host of Options Guide TV inside the Tradier Hub every Monday, Wednesday, and Friday at 11 a.m. Eastern time. So we'll be back on Wednesday. Hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.